Hello, and welcome to the December Economic and Market Update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. After a strong October, November saw generally weak performance in the financial markets. Here in the U.S., while the NASDAQ showed a small gain, the S&P was down slightly, and the Dow lost more than 3%. Fixed income assets were mixed as interest rates crept up, and international markets showed larger drops, with both developed and emerging markets down between 4 and 5%. What drove these results was a combination of two things. On the medical front, the big news was the emergence of a new variant of COVID, raising medical risks again. And on the economic front, the Fed's announcement that they would start to normalize monetary policy. The announcement of the Omicron variant comes on top of the winter wave of the Delta variant. While there were signs that might have been slowing, the Omicron variant raises the medical risks once more. That said, though, we actually know very little about this variant at this point, and any risks are still largely theoretical. Actual data shows that here in the U.S., both case growth and positive testing rates remain modest by recent standards. So while we need to keep an eye on this because the risks are real, it's not something to worry about excessively just yet. And even if we do see an Omicron wave, having weathered 2 Delta waves already, the economy has become more resilient, and any economic damage would likely be constrained. Right now, for example, the economic data keeps getting better. Hiring for October was healthy and included a substantial upward revision to the September numbers. Job growth is still strong. Layoffs dropped back to pre-pandemic levels during November as well. And consumer spending also keeps growing, suggesting that most of the damage from the end of supportive federal programs may be past. Similarly, while rising inflation and policy risks remain a concern, there are signs those dangers may have peaked as well. So while economic risks remain, they now appear to be trending down rather than up. And the Fed's decision to start tightening monetary policy is a ratification of that positive trend. The key question going forward is whether the economy has enough momentum to keep growing until we bring the virus back under control. And so far, the answer looks to be yes. The country remains open, and job and spending growth have stayed healthy through the Delta waves. Given all of that, the recovery looks likely to continue into next year and may even accelerate further. So while the medical risks are still real, the experience of the past year suggests the recovery can survive an Omicron wave as well. Now, that's not to say we're out of the woods. While the impact of a tighter Fed and the Omicron variant have been modest so far, the market pullback at the end of November is a reminder that risks will affect both the economy and the markets going forward. We will likely see more volatility as more risks surface, and there are more risks out there. But as we move into the end of the year, the bottom line is that despite the risks of the Omicron variant, at the national level, conditions are still very positive. And this is what markets are seeing as they stay close to their all-time highs. Real medical risks are out there, but they're risks that can be contained. And despite those risks, growth is healthy and may even get stronger. So while we do need to be cautious, as of right now, it looks like things should keep getting better into next year. That's it for this update. Thanks for watching. Join me in January 2022 for the next one. But until then, be sure to check my daily blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. And above all, have a happy and healthy holiday season. We are getting through this together.